Entrepreneurship is a vital force in an economy of any nation because of the strategic role it plays in achievement of macroeconomic objectives and national development. But it's confronted with many impediments such as the dearth of startups and working capital for expansion. However, findings are revealing that the venture capital in Nigeria exists but is largely not effective. Ineffective venture capital activity has resulted in low number entrepreneurship emergence, underdevelopment of the sector, high level of unemployment, and huge poverty in the country. Let's discuss some of the problems and prospects of venture capital as it concerns Nigeria's economic development. My guest is a development economist and a business developer. He's also the founder of Cashflying Resources, a financial and economic research-based institution, Mr. Victory Anyi. It's also his first time on the show. Mr. Anyi, thank you so much. It's good to have you join us on Business Nigeria.
Thank you very much, Mr. Tolu. It's my pleasure being on your show. I've always looked forward to being on your show. I'm glad I'm on your show today.
Thank you so much. Well, it's good to have you too. Give us an understanding from your end. You have more knowledge of this than we do about venture capital and the positives around it.
Okay, so I'm just going to first start by giving a background about venture capital finance. So in simple terms, venture capital finance is an investment vehicle that relies strictly on equity financing. So the whole idea of venture capital financing is to provide financing to startups with great potential or high yielding that cannot on their own access financing by the regular commercial bank because they do debt financing. So with the venture capital financing model, great startup with great opportunity and their seed stage can access this capital from VCs to be able to execute and bring about the value and bring about the commercial return on investment that's been invested in their business or that idea or opportunity, whatever way it may be.
A good way to start indeed. But where is this funding also coming from?
Also, so bright equity or venture capital have a various way of raising their finances. They raise finance from institutions, raise finance from high net worth individual who have a lot of money in the bank who are looking for a way to invest this money. So a venture capital finance principal will just likely meet this individual and like aggregate this capital. And when they get this capital, they're going to be looking for the great startups or opportunities that can bring about this yield return. And the great market is the US market where you have the likes of Facebook, we have like of Uber, you have like of Airbnb. These are all products of venture capital finance because these are startups that in their early stage couldn't access funding from the commercial bank because they see the model as risky. But the venture capital finance tend to look at the objective from a different perspective. Okay, like what is the return? Is there actually a commercial value in this? Is there a possibility for higher return? And when these checks out, the venture capital is going to apply that financing. So the financing the startup is raising right now is how to execute that idea or that opportunity that is being laid out in the business plan. So when this thing hits, they're going to make a good return of investment, and the venture capital are going to return their own dividends to the principal who they got this initial capital to work with in the first place.
But more of it is looking like there's a focus on the tech space, innovative creativity or innovative platforms. That is where this focus is, because reading through, I see that some institutions like Konga, QuickTeller, Jumia, and all of that were all built through VCs. I think there's so much focus around the tech space. Is that where the opportunities really lie?
Yeah, thank you very much. I'm very glad you brought that out. So the thing there is that in recent time, because America is like is the model for VC. So America has had a huge growth phase, and they're in the fourth industrial revolution, which is tech. So right now, the focus now is more around tech. But the idea is that the whole idea of venture capital is not really around tech. Venture capital is just an innovative financing that tends to eliminate bottlenecks of financing. So venture capital financing is a financing that democratizes access to finance, that ensures an Amina or an Emeka from Enugu State who has less than ₦1 million in his account can access up to ₦1 billion in investment capital. And that money is accessing is not for personal spending, but rather it is a money meant to commercialize that innovation. So innovation can apply in any place. It doesn't have to be tech. The word innovation simply means disruptive. So you can be finding an opportunity maybe in fashion, in entertainment, in real estate, in aviation, in tourism, wherever you find those great opportunities that can scale and bring about high return, that is what innovation is all about. So the VC funding is established to commercialize these innovative processes, because ideally, as an entrepreneur, as a startup, when you're coming with this idea, the debt financing model, which is mostly the commercial banks, see this kind of investment as being risky. But the venture capital, but the VCs are more adventurous in their own investment. So they tend to look at it from the growth perspective. Is there a high return in this? So you can get innovation from anywhere. And the great market is the Chinese market, whereby they are focusing on anything that can bring about return on capital, from FCMB, fast-moving consumer goods, to real estate, to agriculture, to tech, to entertainment, name it, to aviation. Wherever you can get innovation, wherever you can have huge return on capital, the capital is going to go there.
Interesting stuff. But about research shows that about 3 or 4 startups actually don't make it. I mean, they fall out one way or the other. So what do we do to address the risks involved in venture capital investment?
Yeah, so with VC, there's a lot of risks in VC. But then again, if you look about the whole risk, there's a lot of factors surrounding that whole risk of 1 in 4 capital tend to fall. And one of the greatest factors are the VC managers themselves, portfolio manager. Right now, there's one thing we call in the sector, we call FMO, which is fear of missing out. And this is most likely influencing most of the investment made in this sector. A lot of the time, we have seen that VC principals make this investment decision not based on rationality, but based on, okay, could this be the next Airbnb, or could this be the next Uber? Or I had a chance one time to web, I was pitched about Uber and I missed out on that, so I don't want to make that same mistake here. But ideally, VC is like every other business out there. I mean, the whole idea of business is that once you find a value proposition that can give about a return and make huge return on investment and has a guaranteed market on that, you should know that that is a workable business. So the whole idea of de-risking venture capital and financial investors is that the principals who are allocating this capital do their due diligence. That innovation or that opportunity that you're being presented by an entrepreneur, does it have a guaranteed market? Does it have a value market? Does it satisfy a consumer demand? That consumer demand base, is it commercially viable? I mean, if these things are all checked out, then you have a great product. But if you do not do your due diligence in making those investments, definitely you're going to make a lot of mistakes and you're going to have those businesses.
In an economy that unemployment stands at about 33.3%, well, some will even tell you that it's more than that, facing reality of what we see, and poverty figures of more than 100 million, 130-something million, according to the last figures that we have. Do you think this can help address this ugly trend? And how well do you think the knowledge of venture capital, how deep do you think business people in Nigeria have the knowledge of VC?
So, thank you, Bob. So the whole idea of this interview is to bring about the consciousness. And with regards to the question you asked about, I think we should go back in history, memory lane a little bit. So let's go back to the economical history. So in 2014, the American government then announced that they will be cutting their world oil supply by over 70%, because they have discovered shale oil, and shale oil can meet their capacity, that they have it in huge quantum. And that news alone sent a huge shock in the oil market. We saw oil prices going as low as $30 per barrel. Now, that sent a lot of pressure to the Nigerian market, because Nigeria is a largely import-dependent market. And over time, the CBN had to bring out an import restriction list. And we saw over 40 items on that list, because it was practical at the time, because the CBN was having a decline in FX inflow and couldn't finance imports. So it had to let go of this. So it was hoped that when they push this out, it's going to cause a little bit of inflationary pressure on the market. And that will incentivize investors to go about investing in these items, because they have huge market base. These items can be produced in the country. So the CBN at that time was hoping that this pressure will lead about massive investment in those commodities to domesticate production of those commodities in Nigeria. But lo and behold, that didn't work out as planned. Rather, what we saw is that these importers moved to the black market window and created a sudden demand on the FX window, which saw the dollar at the time going to as high as $450, $500 to $1. And what did that do in inflation? We saw inflation going from about 10% at that time to about 18.9% at that time. But the reality there is that if we had this venture capital financing model at the time, we wouldn't have been at this place right at this time, because the venture capital model equity financing has a more direct approach. Because the thing there is that we have a lot of smart entrepreneurs who are involved in this sector, who understand the use case of this commodity, from the production, the supply, and the demand point. But the problem there, because a lot of us, like you said earlier, we're a market of over 130 million persons living in multidimensional poverty. So what that tells you that you have less capital there. So these people cannot start the business on their own. And because we have a situation whereby we do more of debt financing, these guys couldn't access finance from the commercial bank. But if we had the venture capital model operational at the time, we would have structured the use case framework, sent to the venture capital partner. They will evaluate the whole thing and bring about funds in order for us to execute, to bring about the domesticate production of these items in Nigeria. And by now, we have made a lot of headway producing these things in this country. I wouldn't have inflation at where it is today at about 21%.
So what would you say about development finance institutions like the BOIs of this world, the BOAs, Bank of Industry, Bank of Agriculture, the likes of Nexim, and all of these banks? What would you say about their level of support also for businesses? I think development finance has a role to play in all of this too.
Development finance has a role. Yeah, they have a role to play, but right now, their role is kind of minimal because they are still operating on the debt financing. They don't do equity financing. So that still limits how they can intervene in the sector. I mean, the whole idea of debt financing is all about your portfolio. You have to have a workable portfolio so you can assess credit based on your portfolio, which collateralizes the loan you're collecting, or you must have collateral. But the equity financing enables someone who is at the seed stage, who just had an MVP, a minimum viable product, or an opportunity, who has not even started operating, but has a great market to execute. So you see the difference here. So one is more linear, while the other one is more expansive. The debt financing is more linear, has a little bottleneck, has a little barrier, while the venture capital finance equity finance is more expansive, eliminates this barrier and democratizes finance so that I can access finance based on the opportunity I'm bringing on the table. So the development finance have their role to play, but at this point, their role is kind of limited because they cannot do seed funding. The BOI cannot do seed funding. The Bank of Agriculture cannot do seed funding. They only do debt financing, which requires you as a business to have a little bit of portfolio, which they can evaluate and see your numbers before they can think about how much credit they can avail to you as a business.
Back to coining this question, among one of my first earlier questions to you, the investment must have prospects for growth and profitability. That is clear, that is certain, right?
Very, very important. You must have a prospect of return on investment because it's not charitable fund. These are investment capital. So the VC must have a return on investment, and it has to be huge to compel its appetite to make an investment in your case.
What about other African countries? Are they taking advantage of this?
Yes, South Africa is doing a lot in there. That's why you have a more buoyant economy than South Africa as opposed to Nigeria. I mean, you have over a population of over 60 million with a GDP of about $300 billion, where we have a market of 200 million persons having a GDP of about 350. So you can see one is more productive than the other. And the whole idea of venture capital finance is that it democratizes access to finance. And that alone sends a lot of shockwave down so that an average Nigerian who thinks about the fact, oh, you know what, I can actually make 100 million naira or 500 million naira or $1 billion naira with my intellectual capacity just by bringing about an opportunity that can make money for me, for the VC, and for the economy. So this thing adds value to the economy. So what you have there, you're going to have a pool of knowledge of Nigerians who are young, who are energetic, and who are innovative in thinking to bringing about the new opportunities that can bring about value to the economy. Because the whole idea of fund investment, you need to identify an opportunity. If I have $1 billion naira today and I keep it on the table, if I come back in the next 2 years, I'm still going to make $1 billion naira. It might even be worse because inflation might devalue the value of that $1 billion naira. But if I have $1 billion naira and I want $1 billion naira to grow, I'm going to look for an opportunity that can yield dividends on that investment. And this is how the venture capital financing and the entrepreneurship ecosystem bridges this gap. So you have on one side the venture capital financing who will bring in the financing. You have on the other side, which is the entrepreneurship, the entrepreneur who will bring about the opportunity. So both of them are going to study the opportunity and see if there's a value proposition here for commercialization and for return on investment in order to apply capital. So we're able to duplicate this process over and over and over. The new opportunity, the new businesses you set up, the more businesses you are creating, and the more value you add to the economy. Therefore, you're going to create more ways to create wealth, create economic opportunity, create employment, and add more value to the economy.
Finally, if this is totally, fully adopted in Nigeria, Africa's most populous nation, what do you think will be the possibility?
So at the moment, it is not fully adopted. Although we have seen a lot of companies like Paystack, Flutterwave, Jumia, Konga, who are beneficiary of the venture capital financing, but there's still a lot of room for it, especially that we're in this situation right now. I mean, with inflation at 21%, full inflation at 24%, we have no choice right now than to change our model of financing. And if I save a little bit of time, I would like to give you an example of the benefit of executing at scale using the agricultural sector. So if you look at the commodity, for example, like rice, for example. Now, rice, we have a consumption of about 7 million metric tons per annum. That's about 150 million bags of rice at 50 kg per unit. But right now, we're only able to do about roughly 5 metric tons of paddy rice. But if we're able to execute at scale, we have that consciousness of venture capital financing and framework and everything. Say we have a framework whereby we did Nigerian Stock Exchange, for example, creates a portfolio for rice, where we're able to raise capital from the public, through institutional capital and retail investors. And we put that capital to execute, so we're able to enable us to produce rice at scale. So we're going to have a two-sided approach on the process now. We're going to have a whereby we grow the rice. So let's say we get 500,000 hectares of land, whether Taraba or Calabar or Benin. And I use this because those states are very, very critical to the development of this. So we're able to get this, and we're able to do full-scale mechanization farming there. So with that, we're able to have mechanized farming, we're able to do irrigation farming, we're able to do fertilizer farming. So that this way we can produce all year round. Okay, so with that, we're able to have like about 5 million metric tons per annum at a yield of 3 tons per hectare. We could do 4.5 to 5 million tons per hectare at the end of the year. That's on one side. Now, on the other side, we set up the investment to set up the rice meal plant. Okay, so what this does is that we're eliminating a lot of moving part costs, because we have the rice growing farm and the meal plant in proximity. So we just move this rice from there to the meal plant. And we are doing out there. So with the meal plant, we have state-of-the-art rice meal plant. So we can ensure that the output of the rice grains that come out is at par with the rice you get from Thailand or even from Thailand. So when you have this factor, you're able to eliminate consumer barriers, because the reason why Nigerians prefer to buy the foreign rice over the local rice is because the foreign rice is more better than the local rice. And it's not that we cannot achieve, but the reason why we cannot achieve that because we do not have the capacity to do so. So with the big bulk financing, we can do that. So that way now, when we have that output, that scale, we're able to have economies of scale. So the prices of that rice will come down. So we can have a framework whereby we have price coming from 44,000 naira, which it is now, to over 30,000 naira, because while you're operating at scale, so your outputs are more, so which means you have competitive pricing. And that's a lot of value. So doing that, you really have about 33% in food inflation. You have reduced it by 33% on its own already, and you're executing at scale. And also, we can develop more capital from that investment. I mean, imagine if you're able to bring the right of price from 44,000 naira to 30,000 naira per bag, and you said, okay, let's add additional 4,000 at 100 million bag, which is the 5 million metric ton you're getting. Is 400 billion naira annually. With that amount of money, you can fix your infrastructure. You can build a railway track that will enable you move that rice from the farm across Nigeria, which will lower cost again. And you can also do other projects in that. So the capacity to execute at scale is more important now more than ever. And we need the venture capital financing and private equity financing to drive this growth. Right now, we either go big or we go home. And the debt equity financing cannot deliver on that mandate. We need a new form of investment vehicle, which is equity financing.
I must thank you so much for your time. I've been speaking to Mr. Victor Ayin. There is a development economist and business developer. Thank you so much for your insights into this topic of discourse. I hope to see you on the show sometime soon.
Thank you very much for having me. I look forward to seeing you.